In 2012, Tesla was losing money. In 2013, it was still losing money. In 2017, it was burning cash at a scale most CFOs would call reckless. And yet, retail investors believed in Tesla long before Wall Street ever did. Not because Tesla was profitable, not because the numbers were perfect, but because Tesla used 3 specific mechanisms that converted retail belief into capital. Those mechanisms are on full display in this video today. Because today, we're going to break down how Tesla built belief in its mission and strategic vision before profitability. Second thing is that we're going to talk about how it used narrative consistency to create long-term engagement. And third, how it turned shareholders into evangelists. These are investors who reinforced the stock price, not just traded it. And we'll show how Tesla's stock price endured massive volatility, not because of the fundamentals, but because retail belief was anchored in strategy, not the price. So, if you want to know how belief becomes capital and why African mining is still ignoring this in 2026, you're in the right place. Welcome to AfriTenacity. Before we go any further, if you haven't watched the previous video, which is called The Capital African Mining Keeps Leaving on the Table, just pause this video, go watch that one first, because in that video, we laid the foundation by discussing why African mining structurally depends on foreign institutional capital, how that dependency leads to persistent valuation discounts, and why retail capital is systematically underdeveloped across African markets. This episode builds directly on that one, because once you understand that what capital African mining is missing, the next question naturally becomes, how do you actually unlock it? This is not theory. It's also not motivation, but it's real world-class case that shatters the myth that retail investors don't matter. Let's clear something up immediately. Tesla didn't win because it made the best cars at the beginning, nor because it had perfect execution, or because Elon Musk is a marketing genius. No. Tesla won because it understood something most companies, and especially those in African mining, still don't. And that is, capital is psychological before it's mathematical. Retail investors didn't fund Tesla because of the EBITDA. They funded Tesla because the mission was clear. The roadmap of how we are getting there made sense. And the story never changed, even when the numbers were ugly. Tesla didn't say, trust us, profits are coming. They said, here's the future, here's our role in it, and here's how capital today funds the scale we need tomorrow. And that very distinction matters. Here's where people get things wrong. Tesla didn't run traditional advertising. They didn't flood TV, billboards, or newspapers. What Tesla actually did was far more powerful. First, they sold belief before margins. The mission was simple: accelerate the world to sustainable energy. That wasn't a slogan. It was a capital filter. If you believed in that future, you belonged there as a shareholder. If you didn't, Tesla wasn't trying to convince you. Secondly, they explained the strategy before execution. Tesla openly told everyone their master plan. They said, start with the most expensive car. Use that margin to fund cheaper models. Scale manufacturing over time. And then accept short-term losses for longer-term dominance. This wasn't hidden in the investor slide deck. It was repeated publicly, consistently, for years. And the third thing was that they turned shareholders into evangelists. Imagine, retail investors didn't just hold Tesla stock, they defended it here on the internet. They created online communities to explain it. They recruited others into their story, not because they were manipulated, but because they understood what they were funding. This is master-level capital engagement, not hype. According to JP Morgan's Retail Radar, retail investors own about 41% of Tesla's tradable shares. This is well above the S&P 500 retail average of about 5%. Retail investors have been net buyers even during share price declines, with over $7.3 billion purchased over 12 consecutive trading days, the largest retail buying streak in over a decade. On significant sell-offs, for example, about a 14% intraday drop, retail traders accounted for about $201 million in net purchases. This is where they demonstrated buy the dip behavior rather than panic sell. That's not casual participation. That's conviction in action. Retail investors are no longer just observers. They are drivers of demand. And in the case of Tesla, this was especially true when the stock was volatile because they believed in Tesla's strategy. Let's be very clear. Hype is short-term attention without long-term coherent plan. Tesla had the opposite. The first thing is that Tesla practiced the narrative consistency. Apart from the master plan which I mentioned before, for years, Tesla explicitly told investors, we are prioritizing growth, manufacturing and scale, and long-term value creation over short-term profits. This message appeared in its earnings call, its shareholder letters, in public interviews, and Tesla didn't pretend that losses were a surprise. Losses were framed as planned investments. Why does this matter? Retail investors weren't shocked by the red numbers. They were expecting them. The second thing is that Tesla used strategic transparency. Let's take an example. The Battery Day that was held in September 2022 is one of the clearest examples of this. Tesla openly discussed battery chemistry, cost per kilowatt that they were targeting, manufacturing bottlenecks, timelines that were explicitly long, and they even admitted that some of these targets are several years away. After that event, the stock fell sharply because expectations were just way too high. But belief didn't collapse because the strategy was visible, even if execution was delayed. Imagine a mining company openly walking retail investors through cost curves, infrastructure bottlenecks, long lead times, instead of issuing complex technical reports. The third thing was that Tesla had psychological alignment with its capital base. To do this, Tesla chose investors who believed in the mission. Tesla never tried to attract yield-focused investors, dividend hunters, or short-term value players. Its message naturally filtered for growth-oriented, volatility-tolerant, mission-aligned investors. Retail shareholders didn't expect dividends. They expected transformation. This created psychological alignment. The investors matched the company's risk profile. Because of these three mechanisms, retail investors were not betting on quarterly profits. They were betting on manufacturing scale, infrastructure dominance, and systematic transformation. That's why volatility didn't destroy their belief, because their belief was anchored to strategy and not in the stock price. So, why is this level of engagement specifically with retail investors still missing in African mining? Could it be because the mining industry has a blind spot? African mining has one of the most valuable raw material portfolios on earth, and yet retail participation is weak. Valuations are compressed, liquidity is thin, and trust is fragile. Why? Because mining still communicates as if only institutional investors matter. Mining communicates as if retail investors are unsophisticated, and as if transparency is a risk, not a lever that can be wielded. You are in control. Mining companies think the numbers will speak for themselves, but retail investors don't live in models. They live in the narratives, risk perception, and trust. When mining companies are busy explaining reserves, ore grades, and technical reports, retail investors are left wondering what the long-term strategic vision is, what the logic behind the capital deployment is, or how today's diluted equity will fund tomorrow's dominance. Tesla didn't hide complexity. It translated the complexity. Mining often doesn't. Here's the thing though. Mining can't copy Tesla's public persona. Mining can't behave like a tech cult. Mining can't overpromise future outcomes. But mining can learn from Tesla's capital engagement model. That means explaining why capital is needed, not just how much, repeating strategy until it becomes understood, treating retail shareholders as long-term partners, not short-term traders. Mining doesn't need hype. It needs retail capital literacy. And right now, that literacy gap is costing African mining billions in valuations. Even after understanding just how much capital African mining keeps leaving on the table, there's still a huge problem. Because knowing that capital is being ignored doesn't explain why the industry keeps doing it, especially when the consequence is so severe. And if you don't understand the why, then nothing actually changes. And that's exactly what I break down in the next video, why African mines ignore retail investors and why it's backfiring in 2026. Watch this video next, because once you see the real reason behind this behavior, the entire capital structure of African mining starts to make sense. AfriTenacity is here to translate African industries into capital narratives, elevate retail investors into informed participants, so that African industries reclaim power in global markets. So subscribe to our channel by clicking on the button down below, because the future of African industries will not be decided only in the boardrooms. It will be decided by who understands capital psychology and who doesn't. I'll see you on the next one.